Good afternoon, ladies and gentlemen. My name is Shane Squark, and on behalf of the Market Technicians Association, I'd like to welcome you back to another episode of the MTA's Educational Web Series. Today, on March 27th, 2013, we have the privilege of being joined by J.C. Parets as he presents Momentum Divergences and Social Media in Technical Analysis. J.C. is the founder and president of Eagle Bay Capital, LLC. He earned the Chartered Market Technician designation and is a member of the MTA. J.C. is a senior editor of the technical analysis blog allstarcharts.com, which is read daily worldwide in over 150 countries. He has been featured on Bloomberg, Yahoo Finance, CNN Money, Business News Network, and the Wall Street Journal, among other major media outlets. J.C. is an experienced technical analyst with a diverse analytical skill set. Currently, he manages money for high net worth investors, corporations, and charitable foundations. He focuses on all areas of asset allocation, including stocks, bonds, currency, and commodity markets. His approach emphasizes market timing, sector rotation strategies, stock selection, and most importantly, risk management. JC grew up in Miami, Florida, and now lives in New York City with his wife, where he continues to support his hometown teams, the Miami Dolphins, Heat, Marlins, and the Miami Hurricanes. As always, we welcome your questions throughout the podcast. However, in the interest of time, we will not be able to get to them until the very end of the presentation. And now, without any further ado, I am pleased to turn the mic over to Mr. J.C. Parets.
Thank you, Shane. That was a nice introduction. So thanks, everybody, for coming in. I think this is great. I've been, for years, I've been going to different MTA events, the annual symposium, that's next week, obviously. I'm in New York City, so I get to go to all the chapter meetings with great presenters, and I've been watching webcasts like this for such a long time, and I've learned so much that for me to get asked to do this, it just really, really is such a huge honor for me. So let's rip through some charts. I want to talk about a couple of things. I want to start with momentum divergences. It's something that I like to use a lot for entry points, for risk management. It's something that I like to incorporate with all the intermarket work that we do, with sentiment, and so I'll kind of explain a few different ways that we use that. And then, technical analysis and social media is something that I think is really important. It's definitely helped me throughout the years. Even when I first got started in technical analysis, there were different YouTube videos and different websites and stuff that I used to watch. This is before all of these technical analysis blogs that we have out there. So I'll try to touch on that a little bit as well. And then, obviously, if you have any questions, just send them out. I don't see them as they're coming in. I guess Shane sees them, and then he sends them to me. So throughout the presentation, if you guys have any questions, just go for it. So when it comes to momentum divergences, this isn't me, right? So this is the oscillator junkie. We all know this guy. The guy with 27 indicators on his screen. You got stochastics and MACD and ROC. And at the end of the day, all these different measures of momentum that some might agree with one or the other, or some might not. To me, I'm more of a keep it simple, stupid kind of guy. I like the relative strength index. I use a 14-period RSI. To me, that works. And again, a lot of people use a lot of different things. I know a lot of brilliant technicians out there that use stochastics and, they use MACD and, other stuff as well. And that's great. So it really is just what works for you. And this has always worked for me. I watch it every single day, so I know how it behaves. And I'll try to show you guys what I look at. So Wes Wilder first started writing about this back in '78, and I think that there was also a column written about the relative strength index in Futures magazine, if I'm not mistaken, somewhere right around early '79, late '78 as well, where he really goes into it. And it's a very simple measure of momentum. It oscillates between 0 and 100 during bull markets or bull modes, if you will. RSI tends to trade within a certain range, and then in bear markets and bear modes, if you will, it tends to trade in a lower range. And I think it really says a lot about what we're looking at that given moment, whether it be a stock or a currency or a commodity. And as you'll see throughout the charts, it really applies to any asset class. Again, stocks, bonds, commodities, currencies, even different pairs trades that we're looking at, and we really do use them. So this is a bullish divergence. This is what we look at. So when prices are declining and making lower lows as well, and essentially confirming that. Here's basically a picture of when it doesn't confirm that. In this particular case, we have lower lows in price, and the relative strength index is putting in a higher low. So this is what we call a bullish divergence. If we're short, we would tend to cover our position in this particular situation, whatever it is that we're looking at. If we're looking to buy something, if there is something like this going on at a former level of support in the past, or there's some, for whatever reason we're looking to buy it, this would kind of be confirmation on the fact that we're probably looking at the right thing. And this is the complete opposite. This would be a bearish divergence. So when prices are making higher highs, you also want to see momentum making higher highs as well, and essentially confirming that. And in this particular case here, you have a higher high in price, and you have RSI putting in a lower high. And I just want to stress that both of these things, it's critical that they're in overbought and oversold conditions. So in this case, notice how the first higher high is in very, very overbought conditions, while they're classified as overbought as anything above 70 and oversold anything below 30. So I just want to reiterate that these divergences need to come from overbought conditions for us to consider them valid. And just going back here, same exact thing on the bullish divergences, you want to see these divergences coming from oversold conditions. In other words, below 30 for us to consider them bullish or bearish divergences. So here's a good example. I'm just going to fly through a bunch, different asset classes, different stock indexes throughout the years. Here's the S&P 500 last summer. Prices are making lower lows, and here's momentum putting in a higher low. And this bullish divergence was really standing out for a lot of reasons, right? So it's not just one thing. There's no holy grail. There's nothing out there in the market that if you do the exact same thing every single time, it's always going to work. That doesn't exist. So the idea is, and the beauty of technical analysis is that we can use so many tools and bring it all together, and when they tend to agree with each other is really when we have conviction on any particular trade. So, in this particular case in the S&P 500 last summer, you Elliott wave guys may be counting 5 waves down here. That looks pretty clear to me, and you also have a bullish divergence in the relative strength index. At the same time, you had some other asset classes doing something similar. Here's silver. In the same time frame last summer, prices are making lower lows into late June, early July, and momentum is putting in strong divergences, huge divergences. And this is happening at the same time as the S&P 500, which at the time, these guys were pretty highly correlated. So the fact that both of these asset classes are telling us the same thing really validated what we were seeing at that particular moment. Here's the exact same thing. Here's the euro. In the exact same time frame, daily bars last summer, prices in the euro are making lower lows, and sure enough, here you have the relative strength index putting in a higher low, and here's the bullish divergence. And notice how all of these, in silver, in the S&P 500, all around the same time, and these divergences are coming from oversold conditions. So we're seeing all of these things telling us the exact same thing, right? Risk on, things priced in dollars, buy them, right? Silver, S&P 500, the euro. And sure enough, what's happening around this time? Sentiment was that the euro is essentially going to zero, right? Remember last summer? Literally the euro was going to zero. Here's the cover of Barron's on July 16th of 2012, saying that the euro and the dollar were going to parity. And sure enough, 3 days later, the euro bottoms and has a rip-your-face-off rally. I mean, you literally could not draw it up any better. And silver was telling us the same thing. You're seeing the exact same thing out of the S&P 500. So again, the intermarket analysis, the momentum divergences, the Elliott wave, it's all really coming together. The sentiment, obviously, all good things. And sure enough, at the exact same time, here's the United States dollar making new highs in the summer, and here's momentum rolling over. So literally the exact opposite of the Euro USD. Here's the Euro USD. Here's the dollar index doing the exact opposite. Again, everything saying something similar or saying the exact same thing. So I think it's important to recognize that when all of these guys are kind of screaming at you to do something. Here's the cover of Parets. It's funny. So in July, cover of Barron's is euro and dollar are going to parity. European stocks and the euro have been very highly correlated. Doesn't matter. Here we are around Christmas. Here's December 24th. Barron's, Europe, time to buy. And sure enough, 3 days later, here, this is the Euro Stoxx 100. So the top 100 stocks in Europe relative to the top 100 stocks in the S&P 500, right? So the S&P 100. So this is the relative chart. And that Barron's article saying to buy Europe was on December 24th. This ratio peaked on December 28th, telling us to do the exact opposite, be in U.S. stocks and not European stocks, new highs in this relative pair while the relative strength index is rolling over. So again, a combination of sentiment and momentum really telling us the exact same thing, and that's great, and that adds validation to these divergences. Here's another example. This is the S&P 500 back in 2011. Same thing. I think it's pretty clear. One of my favorite things that I like about these bullish divergences, right? So you have these lower lows in price. October the 4th, if I'm not mistaken, if you recall, the pessimism in the market was extraordinary. I remember specifically this next low in November. This was right around Thanksgiving. The volume bars aren't in there, but very, very low volume. I remember I was in Texas. I was in Dallas for the Dolphins-Dallas Cowboys game. And I remember just looking at, my tweets and just looking at emails and just the pessimism out there around these lows. Same thing here at these lows. Market was going to zero. Momentum was telling us otherwise. And I really like this false breakdown, right? So these lows couldn't hold for very long. So you knew at this point here, basically on this bar right here, that we're now getting above these lows. That's essentially confirming that false breakdown. And, like my friend Brian Shannon always says, from false moves come fast moves in the opposite direction. And that's exactly what we got. In fact, we never looked back. Those were the lows. Those were, what were the lows there? 1080 on the S&P while we're sitting here at 1550. So you got to appreciate that. And just look back at the sentiment at that point. So the low was October the 4th, 2011. Here's the Wall Street Journal. As the autumn starts, a bear market chill sets in. Concern over recession weigh on European, Asian markets. This is the day that the market is bottoming. Just pessimism, across the board. This is probably one of my favorite examples. And again, the relative strength index and momentum divergences, we really use them on all time frames. We use them on 10-minute charts. We're using them on daily charts. I'll show you a chart of Brazil of today, actually, on a 30-minute time frame, a nice divergence. This is a weekly chart. And you could see this is the bottom in 2009. And as prices were making new lows in March, momentum was putting in higher lows. You see that? Isn't that beautiful? And you were seeing something similar at the top back in 07. See, higher highs, 2007, lower highs all the way down. And momentum was diverging on the weekly chart on the S&P 500 as prices were making new highs. And again, it's not just momentum. It's not just the price action. But there's a lot of other things going on here. I mean, this is the most beautiful 5-wave Elliott count, I may have ever seen in any chart ever. Here's a perfect 3 of 3, in my opinion. 4, 5, and then it ripped, and that was beautiful. Obviously, sentiment at that point. Remember, in February and March, the market was literally just melting down every day. It was ugly. So you had sentiment at historic amount of bears back then. A nice Elliott wave count, momentum divergences, and it's not here, but the New York Stock Exchange, new highs and new lows. The new lows in the New York Stock Exchange peaked in the October low, which is this low right here, which was, if I'm not mistaken, October the 10th, if I'm not mistaken. That day was the peak in New York Stock Exchange lows. And then in the November low, we had even less amount of lows. And then in the March lows, we had even less amount of lows. So the internals of the market were already improving as prices were making new lows. So the internals, the sentiment, the Elliott wave, the momentum, all these things really telling us the exact same thing. So we have a question. What's your time frame? Can this work for short term? Yeah, 100%. We use it, like I said, we use it in 10-minute time frames. This is a weekly. We use it on 30-minute time frames. We use it on the dailies. So yeah, 100%. Because remember, the RSI is a 14-period RSI. So it measures the strength relative to the weakness, of course, over the 14 periods, whether those periods are days or weeks or months or minutes. So let's remember this. I mean, a lot of us know this chart very, very well because it was the bottom in 2008. But look what was happening at the same time. So this is the consumer discretionaries versus consumer staples, right? So things are great. Markets are ripping. Institutional fund managers need to allocate capital into risk assets. They're going to put their money into consumers, retailers, and home builders, and automobiles, and everything like that at a much faster rate than they would into consumer staples, right? So if the economy is poor and times aren't very good, we're still going to brush our teeth and wash our dishes and drink beers and smoke cigarettes and drink sodas. That's not going to change. So when fund managers are scared and they need to allocate capital, they would much rather allocate their money to Coca-Cola and Anheuser-Busch, Procter & Gamble, Colgate-Palmolive, Philip Morris, those kind of companies, as opposed to home builders and retailers and things like that. So this ratio is one that's really, really important to us. So this compares both of them. And sure enough, the bottom in the discretionaries versus staples was in November. So as the S&P 500 was making lower lows into March, this was already putting in a much higher low. See that? And the internals of the market, as we mentioned before, with the New York Stock Exchange 52-week low list deteriorating, obviously money flow was telling us the exact same thing. And sure enough, on this new low in November, this particular ratio had a nice bullish divergence. So there was a lot going on here telling us, that being scared and running away was probably not the best idea. This is the exact same time frame. These are weekly charts, weekly bars of the U.S. dollar index and the S&P 500 at the 09 bottom. I remember like it was yesterday. This is probably one of my favorite false breakouts of my entire career. I think I've written about it before. This is as beautiful as it gets. At the time, the U.S. dollar and the S&P 500 were very, very negatively correlated, like almost -1. You guys could go back and do the math, but if the dollar was up, U.S. stocks were getting crushed and vice versa. And then look what happened. Into March, the U.S. dollar index made a new high while momentum was rolling over. See that? And while the S&P 500 was doing its thing. And once again, from false moves come fast ones in the opposite direction. And the dollar got absolutely decimated. It's a beautiful thing. And the stock market rallied. It was awesome. Here's the NASDAQ back in 2000. Look at those new highs into 2000. And momentum rolling over. I mean, it's pretty clear. So sure, prices kept making new highs, Momentum keeps making new lows, and that bubble popped pretty viciously. So here's gold at the end of 2011. Talk about former support and resistance levels. So again, it's incorporating other tools that we have as technicians into our work. And look at the resistance in the summer of 2011 in GLD. We broke out, came back, retested. So this resistance here turned into nice support. We rallied again, came back down. And as we're making new lows, I remember this was like right after Christmas. Very low volume. No one's really paying attention. The rally and this false breakdown here was really catching my attention. I'm pretty sure I did an interview on Yahoo Finance like January 4th. So something like right around here, and I was talking about this bullish divergence that we were seeing with prices making new lows and this potentially being a false breakdown. I think gold and silver, precious metals, were the best performers that January, February. It was awesome to watch and witness and participate in, obviously. Let's see what we have here. So here is here utilities versus the S&P 500 right now, actually. So at these lows here, momentum's putting in higher lows. So it's something interesting that we're watching is that rotation into into utilities and out of the S&P 500. We're watching this very closely. I love this divergence. To me, it looks like it can go a lot higher. Here's the Euro Stoxx 50. Obviously this has been making all the headlines as European stocks are getting destroyed. this was the day after the Super Bowl. So this gap lower here was February the 4th, if I'm not mistaken. And this kind of island reversal, if you will, in FEZ, which is the Euro Stoxx 50 fund, kind of left these guys hanging. So, you guys that, look at specific price patterns, which I guess we haven't really discussed so far during this webinar. This is a beautiful island reversal here, gap lower, and you have a bearish divergence. I mean, a thing of beauty, right? And these things are just getting absolutely crushed, rallied, rolled over. A lot of these names are doing worse than others. Italy, Spain, Poland, absolutely decimated. Greece, obviously. And then some of the better, more quality, quote-unquote, countries like Germany and France kind of look a little bit more like the index itself. It look a little bit more like this. All right, so we have a question. So there, a bullish divergence in gold right on. Am I reading this correctly? That bullish divergence in gold was in 2011, in December of 2011, going into the beginning of 2012. So that's actually not right now. The only charts that are those are historic charts. That's this one. The utilities and staples, that's current. That's as of today. This is the Euro Stoxx 50, which maybe have been as of yesterday, but this is pretty recent. Here's another one I'm looking at. This is the dollar yen. I've been talking about this a lot lately. It's fascinating to me. I think that if it's going to roll over here, it's going to do it soon. Otherwise, we might get either one more high or maybe a little bit more consolidation before it rolls over. But nice bearish divergence in this one, coming off of overbought levels. We haven't gotten price to confirm yet, but it's definitely something that we're watching closely. And this particular, getting back to intermarket analysis, this particular currency ratio, dollar yen, is very highly correlated with the S&P 500. I mean, the S&P 500 kind of essentially looks like this. So I think that if money comes out of S&Ps, I think this is where they're going to run. I think they're going to run towards the yen. So this is a very important chart that I think if you have risk in the market, I think it's something that you really need to be watching because of that very high correlation. And it doesn't always work, divergences. Here's a couple of examples of them not working. Here's Yahoo in a few months ago, and sure enough, beautiful divergence coming in, and prices not confirming, prices making new highs. So it doesn't always work. It's not a holy grail. So you really need to respect price and manage risk by watching price, not just see these divergences and go in blindly without worrying about, okay, where am I wrong? I think that's the big question that, market participants in general don't really ask themselves. And my trader and I, we talk all day long about a million different trades, a million different asset classes, and the question isn't, all right, where is it going to go? The first question that we ask each other is, okay, where are we wrong? It doesn't matter where you think it's going to go. It doesn't matter at all. You have no control over it. You have no idea how high it's going to go after you buy it. You have no idea how low it's going to go after you short it. You have no control over that. So why are you going to worry about it? So what we worry about is where are we wrong? So in the case of Yahoo, we were long very, very quickly. We got ripped in our face when we got short, and we got out, and it keeps making new highs. This chart isn't updated. This is as of February 12th, but Yahoo went a lot higher after that. So you really need to respect price. Here's another great example of one not working. Talk about strong trends. Home builders last year were, I think, the best performers. And we have a nice little divergence here going into November, December, potentially a nice breakdown. Sure enough, this was a false breakdown, and we ripped to new highs. So, again, you really need to respect price, wait for price to confirm, to really add on. And if you're wrong, and get out. And because when these divergences don't work, there are larger forces at work, which I think is important to recognize because my friend Jeff Hirsch over at Stock Traders Almanac says the same thing about seasonality. Seasonality is great, and I think it's important to watch how the market behaves in January and February, sell in May and go away, and you guys know the whole thing. When markets are historically supposed to do something, like the S&P 500, for example, in the month of February tends to decline and tends to kind of slow down. When that doesn't, that's the market telling you that there are larger forces at work. The S&P 500 this year is a perfect example of that. We've seen it before. Sell in May and go away. Also, if we're ripping through the summer, and that says a lot about the fall. So I think When it comes to divergences, it's the same thing. When they don't work, look out, because there's a lot more going on that you might not be recognizing. Here's Devon Energy, another beautiful example, nice false breakdown in DVN, beautiful bullish divergence, and of course, ripped higher. I mean, this was a thing of beauty. A friend of mine came into the office and says, JC, pull up Devon Energy, look at it for me, and I literally pulled it up, and we bought it maybe 30 seconds later. I mean, that's literally how fast we acted on this, which says a lot about technical analysis. I don't need to do 10 hours of research about Devon. You know, I know they're in the natural gas space. That's enough for me. I really don't know much else about the company. Here's Platinum Gold. This chart isn't updated. This is as of last month, but I just want to point out the divergence. This is a weekly chart of platinum versus gold. Here at a very clean bottom here around, what, 0.85, 0.86 on the spread, and a nice bullish divergence, and this thing's been doing very, very well. I think it could go higher. Obviously, price is what's going to pay us, so we really want to be careful with this thing. Let's see where it is today. This particular spread is right around 1, so it's right around here. You know, so we really want to watch price and make sure we don't get a breakdown. But these divergences are really strong. We probably want to start seeing some overbought conditions in RSI. I'm going to get to how important overbought and oversold conditions are in terms of the strength or weakness of a particular asset class. So for confirmation, we definitely want to start seeing some overbought conditions, which we have not yet. Here's another one that didn't work. Here's coal. Coal's making new lows into the fall, and here's momentum putting in higher lows. Beautiful base, very clean level that we were waiting for to buy a breakout potentially. It never happened. In fact, we broke down. We actually initiated some short positions. It didn't work, so we know there are larger forces at work here. This is a huge downtrend. Sure, if we would have broken out, it would have worked. We had a ton of upside, a ton of potential upside, which is why we were interested in the first place, but only price pays. Price never broke out. It broke down, actually, so this divergence didn't work, and that happens. So we really need to be careful for that. Here's another one that didn't work. Here's Walter. I guess it technically hasn't not worked, but it has, you know, we never got a buy signal generated. We're still here well below these levels. We're down here around now. This is as of February, so prices came back down. We had a nice divergence. We never broke out, so there was never a reason to buy it. So again, sure, we have these divergences. It's great. It's almost like a heads up almost, like, hey, you should probably take a look at this. And it was a nice false breakdown and everything. So this is one of some of all my favorite things. And we never got confirmation to the upside, and that's fine. There's nothing wrong with that. Here's one today. Here's the Dow Jones Industrial Average relative to Vietnam. Nice bullish divergence on these new lows in February. Ripped higher, have been consolidating nicely. So this is the Dow Jones Industrial Average relative to Vietnam stocks. So I'm pretty sure this is based on the Ho Chi Minh Stock Exchange Index. And it looks great. And if we can break out of this, we might have another leg higher. But this is a beautiful divergence that I definitely want to point out. So this is on a daily time frame. Here is a 10-minute time frames on S&P E-minis today to show you the different time frames. So these are the futures contracts, the current contract on the 10-minute time frame, and look at the lows that were put in. These lows were put in right around the open, right around 9:15, 9:30 in the morning. So on lower lows in price in the E-minis, look at the bullish divergence in the RSI. So I added this here last minute just because it was so clear. We were looking at it. I'm pretty sure we bought the S&P 500 right around here. And we're still holding a little bit, kind of sold some into here, but we have a little bit left. But that's a beautiful divergence that I think that we need to recognize that happened intraday. Now, if we would have, you know, kind of rallied a little bit and rolled over and taken out those lows, even in the face of that divergence, things could have really, really gotten ugly. And I think that's exactly what we were saying at the time. It's like, man, if this divergence doesn't work and these stocks roll over, it's going to get nasty. But it didn't. And we bought the S&Ps, and it worked out well. Here is Brazil on a 30-minute time frame. Nice, beautiful downtrend. If you guys have been watching Brazil, this thing's been absolutely crushed with the rest of emerging markets and Latin America as a whole, for that matter, minus Mexico, I guess. Absolutely crushed. Nice bullish divergence. This chart was as of 2:30 today. So let's see how we closed. We closed at 54.23, so a little bit below there, actually. But nice resistance that was broken. This should act as support. If it rolls over, look out. But this is just an interesting bullish divergence that we're seeing on a 30-minute time frame. So again, a lot of different things going on, different time frames, 10 minutes, hours, weeklies, dailies. So when stocks are in bull markets, or not just stocks, but bonds or currencies or whatever it is that we're looking at, a particular spread, when they're in a bull mode, when things are good, they tend to get overbought. They tend to stay overbought. They tend to find support around the 40 level. If they're really strong, they tend to find support around the 50 level, which is right in the middle, but never get oversold. They just get overbought. So when things are good, whatever it is that we're looking at, the euro or the dollar, whatever, this is how it should behave. This is how RSI should look. Not like this. This is how things in bear markets look. These are, gold miners and different steel companies and coal companies and things like that. This is what they look like. They get oversold and they never get overbought. And it's the same as here, but the opposite, right? So they tend to roll over right around the 60 level, never reach 70. And if they're really, really weak, they tend not to get above 50. And this is the way that bad stocks act, or bad markets act. So here's a good example of that. Here's Moly Corp back in 2010, 2011. Remember rare earth metals? Remember how fun those times were? A lot of money made in rare earth metals and a lot of money lost since then. But at the time, Moly Corp was the blue chip of rare earth metals, if I remember correctly, if there is such a thing. And sure enough, look how it kept getting overbought. See that? On all the new highs, gets overbought, never got oversold. See how it kept finding support right around 40? Never, never, never did it get oversold. And it was a beautiful thing. And then I think it came crashing down. And I think it's making all-time lows as we speak. But at the time, RSI was confirming everything that we were seeing in Moly Corp. So here's the complete opposite. Here's JP Morgan in 2008 when financials were all in a bear market. Same exact thing, right? Never getting overbought. Look at the resistance every single time, right around 60. Never getting overbought ever, but consistently getting oversold. Why? Because it was in a bear market. This is 2008. The bank in 2008. You can only imagine. So RSI was confirming that this thing's in a bear market. Nothing's changed. Short rallies. I mean, that's what RSI was saying here. And I think this is a really good example of that. And this is current. It's not an up-to-date chart, but here's a weekly chart of gold miners. One of the worst areas on planet Earth, and sure enough, hasn't gotten overbought in years. Just gets oversold. So I think that's a good example of a bad chart. So here's a beautiful bullish bearish divergence in a stock that I'll show you guys now what it is. At the time, it was very, very clear. This is when everybody and their brother was long Apple. So this is what Apple looked like before the crash. And you have a beautiful bearish divergence on the new highs. I remember specifically around that time that I could not think of a single person that I knew, professional, retail investor, you name it. Every single person that I knew that Apple was going higher and knew that Apple was a buy. Literally everybody. They're raising their price targets every day to over 1,000. I mean, you guys remember. And sure enough, it came crashing down. So this is Apple on a daily time frame. Here's Apple on a weekly time frame. The exact same thing. So you have the weekly confirming the daily. So multiple time frames telling you the exact same thing. Apple before the crash, and this is what it looked like after the crash, and it went even a lot lower after that. These charts are from February. But again, the daily charts, the weekly charts telling us the exact same thing. Here's Apple relative to the S&P 500, again at the exact same time. New highs relative to the S&P 500. Momentum is rolling over at the same time that the daily chart and the weekly chart is telling you to be careful and get the hell out of the way. You got the relative chart telling you the exact same thing. And here's the relative chart on a weekly basis. This is the daily. Here's the weekly, same exact thing. New highs on a relative basis relative to the S&P 500, and momentum is rolling over. So you got the daily chart telling you to get out of the way, the weekly chart telling you to get out of the way, the relative chart on the daily saying get out of the way, and the relative chart on the weekly saying get out of the way, and everything saying the exact same thing except the cab driver that is telling you to buy it. So I blogged about it, and this, we can transition a little bit into the social media world. I wrote a nice blog post about it, and at the time, I think it was in September, and you want to talk about sentiment. I have never gotten so much hate mail in my entire life than whenever I said anything bad about Apple. Like, the cult would just come out and crucify me because I didn't think that those 4 letters were going higher. I thought, for whatever reason, that they were going lower. And just all of that email and all of that negative feedback really just confirmed the exact same thing that we were thinking, that everybody's bullish, everybody thinks it's going higher, momentum's rolling over, we need to get out of the way. So I've been writing the blog for 2 years. It's been great. Over the years, I've been able to meet so many people because of it. I've learned so much about the market and about myself. It's great to put ideas down on paper. You could go back and refer to the blog and see what you were thinking at that time. It's out there for everyone to see, and it's great. There's some awesome guys out there doing the exact same thing. Here's a friend of mine, Ryan Detrick, chartered market technician. He's over at Schaefer's. He puts out quality stuff every single day. Really, really smart guy. Awesome dude. Here's Mark Arbetter, another chartered market technician. He is at Standard & Poor's, and he's putting up YouTube videos, doing technical analysis on intermarkets, currencies. He did something on treasuries a couple days ago on yields. He talks about every market, all the currencies, puts up YouTube videos for everyone to see. And as market participants, as technicians, we have to appreciate that. I mean, a guy like this, a true professional, really sharing his work with us is fantastic. Here's another brilliant technician, Brian Shannon, friend of mine. I've been watching Brian Shannon's videos, no lie, since 2006. This guy would make YouTube videos at the end of every trading day, 5 minutes, 6 minutes long, very quick, to the point. Here are the Qs, here are the S&Ps, here's a couple of stocks worth watching, here's gold, just straight up to the point. Your financial semis, Russell, and, really a guy I've learned a lot from. His book, Technical Analysis Using Multiple Time Frames, excellent book, one of my favorite books on technical analysis ever. In fact, I got word that I passed my CMT level 3 in July of 2008, and I was actually leaving to Italy to go propose to my wife, actually, and I needed a book for the flight. Called him up, he FedExed it right away, and I read his book cover to cover by the time I landed in Europe, and just a great book, very, very simple, easy to read, fun to read, awesome. It was actually the first book I ever read voluntarily on technical analysis post CMT program. So he's alphatrends.net. Here's Kimball Charting Solutions. So this is Chris Kimball, awesome technician. Been following his blog for a long time. He's in Kansas. I absolutely suggest reading his blog. Awesome technician. Here's mine, All-Star Charts. Here's an interview I did with Ralph Acampora back in September. Got a lot of great feedback from it. A lot of people loved it. I loved doing it, obviously. When you get to pick the brain of a guy like Ralph, who's been through the trenches for this long, I basically asked him questions that I wanted to know the answers to. And, people liked it a lot, got a lot of great feedback. So I definitely suggest going back and read that. Here's Corey, Afraid to Trade. Corey Rosenblum is a chartered market technician as well. He's out in Alabama, if I'm not mistaken. Great blog. Does a lot of intermarket work, a lot of work with Fibonacci as well. Great blog. Greg Harmon, of course. A lot of you guys on this webcast probably go to Dragonfly Capital and see Greg's work. Greg is a CMT and CFA. Great blog. Also, a lot of intermarket work as well. Here's a question. Assuming we are before the second low, we don't know the next low yet. How should we react? Should we wait until we see the next low and the divergence? That's actually a great question. So getting back to the momentum divergences before I continue, that's a great point. So at what point do you say, okay, there's a divergence setting up, or there's a divergence confirmed? we played around with the numbers, and you can kind of create, depending on what your time frame is and your trading style, you can, and also depending on what technical analysis software you're using. A lot of them allow for you to kind of set alerts and set different screeners, so you can essentially classify what you would consider a bullish divergence, what you would consider a pivot low, how many days to the left and to the right of that particular pivot low you want to use before it starts to give you those alerts. So it really depends on a lot of things. Your time frame for one, and also how many alerts do you want to get? I mean, how many of these potential divergences do you want to see? So it really depends on how much you want to filter it, how few signals you want to generate, or how many signals you want to generate. You could really play around with it. At the end of the day, I think it's important to recognize that a divergence could potentially be happening. A good example of that, I think, is in natural gas last spring, right? So spring of 2012, prices were getting absolutely crushed in natural gas futures, and on the daily chart, RSI just got so bad that you kind of figured that the next low in natural gas would create a bullish divergence, just because the way the math worked out, it would be so difficult for it to make a lower low in RSI. So you kind of already assumed that the bullish divergence would appear. Just the question is, how low would that next low be, and where do you buy it, which obviously makes it trickier. But sure enough, it made a lower low, the bullish divergence appeared, and natural gas ripped higher. So at that point, it really becomes about risk management and looking at price as far as entry points. So it's great that you're getting a heads up on the bullish divergence and everything like that, but price is the one that needs to tell you where to act and where to manage your risk. So that's really my answer to that. As my friend Brian Shannon says, only price pays, right? So just a few other guys that I wanted to mention. John Boorman, another chartered market technician, gentleman I met about a year ago. Nice guy, smart guy, just started his own technical analysis blog as well, Alpha Capture. It's brand new. I've read a few of the posts already. Not surprising that it's awesome work. I wouldn't expect anything less out of him, but definitely one to add to the list, I think. And really, just the community in amongst technicians, I think, is important. There's no trading floor. There's no New York Stock Exchange where you're talking to your buddy and who's trading next to you. I mean, that doesn't exist anymore. Traders are in front of their desks, and some of us are fortunate that we, like for example, I live in New York City and we have an office in Midtown Manhattan. But if I lived in the desert, in my computer, I would have the same exact access to other traders around the world through StockTwits as I do here on 44th Street and 5th Avenue, just because of the online community that StockTwits has really brought to the table. It's not Twitter, where on Twitter you could tweet out anything you want on any stock, whether it be a penny stock or whether it be a large cap, whether it's true, whether it isn't. StockTwits is curated, it's filtered, so there's no BS, and there's some brilliant guys out there. And similar to Twitter, you can really kind of curate your own stream of people or technicians or news sources that only you want to hear from. There's some guy tweeting about some stock, and you don't like him, or he's annoying, or he's wrong, and you don't need to follow him, and you never hear from that guy ever again. It's a beautiful thing. So StockTwits.com, I'm All-Star Charts, but there's brilliant guys. And this is essentially what it looks like. Just smart guys talking about what they're seeing, sharing ideas, and also consuming ideas as well. I promise you that every single person on this list, and this is just example of a few guys posting some charts and some comments, I promise you that they are absorbing as much information as they're dishing out. I know I do. And these guys they're publishing charts all day long. Here's the growth of the charts per day on StockTwits. This is for the last couple of years, literally just growing. Obviously, social media isn't going anywhere. The markets aren't going anywhere. People are still going to be talking about them, still going to be sharing. So I think it's important to recognize that that's going on, and there's value there. I mean, I've been as part of a community for years. It's great. Here's just a couple of examples of some guys putting out some charts, two CMTs that I respect greatly. Chris Burba and Ari Wald. all day long, just sharing charts. Hey guys, this is what I think about this. This is a chart that I think is interesting. Here, check out silver, check out whatever. You know, it doesn't matter. These are smart guys, obviously chartered market technicians, guys that have put in a lot of work in their education and in their profession, and are willing to share ideas that they're seeing. And it's great. It's fantastic. Here's a close-up of what Ari was tweeting out. This was on February the 8th. He was talking about how the Qs were attempting to break higher, and at the time there was a low correlation with the S&P 500. Again, fantastic. And this is what the technical analysis community is doing. And the fundamental community has caught on and is doing something similar. A good friend of mine, Lee Drogan, started Estimize, where it's open to the public. Professional analysts, amateurs, anybody could go in there and give their earnings per share or revenue estimates for a particular stock, for their quarterly numbers. And sure enough, you know, because a lot of the people that are submitting their estimates don't have any biases, like a lot of these sell-side, you know, some of these sell-side shops, they have biases. If they're doing, you know, investment banking deals with a specific company, it's you know, putting in sell recommendations is probably not, you know, what they should be doing. These guys, there's no biases, and sure enough, they come a lot closer to the real number than Wall Street. In fact, almost 70% of the time, the estimized number is closer than Wall Street's consensus. I think that there's a lot to be said for that. This is basically what it looks like. I'm a technician, so you know I don't claim to be an expert when it comes to earnings per share, or I wouldn't even know where to start trying to figure out what Dell's going to come in with revenues. I mean, I have no idea. So it's not something that I participate in, but I know a lot of smart guys that do, and I think it's interesting and worth noting that while the technical analysis community is sharing charts and you know doing intermarket work on the stream, the fundamental community is doing something similar, and it's growing as well. These are the estimates per week. You can obviously tell what the spikes is every time that it's earnings season, but sure enough, the chart goes from the lower left to the upper right, right? And that's me. I started the blog All Star Charts about 2 years ago. It's great. It's obviously helped me, as I've mentioned before. I started a hedge fund late last year. You know, things are going well. It wasn't the easiest thing to do in the world, as you can imagine, but I definitely learned a lot along the way. I have this new area of expertise when it comes to launching a hedge fund. It's not fun, but we got through it, and you know, we're able to manage money the way that we want to manage it. In our opinion, you know, we built it the way it was most efficient for everyone involved, I think. So we're here on 44th and 5th Avenue. That's me. I got my CMT back in 2008. So I'm a technician through and through, and you know, I hope I showed you guys some good charts and kind of expressed the way that I look at markets. I hope I did a good job. So let's answer some questions. What are your thoughts on the divergence between gold and gold miners? So like what? The Gld Gdx Spread itself? I've been pretty vocal about that particular spread for a long time. It's one of the most beautiful charts out there where GLD has been outperforming GDX for a long time. And it could be for a number of reasons. Not that the reasons really matter, right, because price pays. But one of the most interesting theories behind why GLD outperforms consistently GDX, the gold miners, is really because prior to GLD, which is, by the way, one of the biggest ETFs in the world, if it's not the biggest, it's definitely top 3, I think. So historically, if you wanted to buy gold and you wanted to be invested in gold, other than just buying futures or bullion, you would buy the gold miners. You'd buy Newmont and Barrick and all those. But now that you have GLD and you could get direct access to gold, just by GLD. And I think that the chart of GLD relative to GDX, I think, is telling us that. I am checking Gold Corp have 3 bottom and RSI is higher high. So as per you, this stock will go high, but timing says gold will go lower. How do you play? Gold Corp, GG, right? Oh my God. I mean, these things are just absolutely decimated. You're essentially bottom fishing. This is one of the worst areas in the market. I do see a little bit of a divergence for sure. We've actually been watching GDX specifically. I would say that this chart looks better than GDX. There's definitely in Gold Corp some pretty heavy resistance around 33, just under 34 bucks. It's definitely an interesting one. I'd want to see a breakout. I'd want to see it hold. I think it definitely has the potential, to go up 10, 15% for sure if this in fact is a bottom. And it can be. I mean, these guys have gotten absolutely crushed. It's been one of the worst areas to be in. And to your point, in Gold Corp, there's some support here from last summer. So this would be a logical area for it to find a temporary bottom. So that's actually a good call. Is there a common website that screens for these divergences? Maybe. Not that I know of off the top of my head. A lot of different charting softwares allow you to create screeners, different filters, and you could be creative with how you define those. So that's what I would recommend for sure. Because then you can make it however you want. So it's not other people's screeners; it's yours. So is RSI to confirm price, not to signal a price move? So RSI, you want to see it confirm price. So if markets are in bull mode and making higher highs, you want to see RSI doing the exact same thing. When you don't see that, there's a bearish divergence. There's something wrong. So if we're long and we're seeing that, it definitely gives us cause for concern. And if we're looking to enter a short position and we see something like that, it definitely gets us excited. And same thing to the downside, right? If we're short and prices RSI is not confirming prices making new lows, like in the case of gold miners, right here, GG, a great example, you really want to be careful. And if you're looking to buy something for whatever reason and you see that, I think it adds I think it adds validity to it, to what you're seeing. Can you repeat the URL for your blog? Sure, it's allstarcharts.com. ALLSTARCHARTS, allstarcharts.com. Can you please speak a little bit about the current NASDAQ composite divergence, if there is one? Let's see. I would say that the biggest divergence out of the NASDAQ composite is the fact that it isn't. It's definitely underperforming the S&P 500 and some of the other averages. So that's the first thing that I would note. Second of all, notice how the NASDAQ composite on the daily time frame hasn't reached overbought conditions since September, since the September peak. So that's definitely cause for concern. So it's underperforming the other averages. I'd imagine that Apple probably has a lot to do with that. It's got to be probably a big weighting there. I know the Qs have a similar problem. I would look at QQEW, which is the equal weighted. I guess it's showing a similar divergence as well. We're seeing these divergences in a lot of the major averages, S&Ps, Russell. It doesn't mean that we can't make another higher high. We absolutely can. In fact, we probably will. But those divergences are definitely in place, and they're telling us to at least be careful. The price hasn't said to go short and go nuts on the short side, but I think it's worth noting that they're there, and definitely be careful. Why are so many on CNBC so afraid of admitting that they are reading charts? I have no idea. Ralph Acampora I asked him a similar question, about technical analysis and fundamentals, and a lot of it really, he took it back to the Great Depression. I think it was 1930 or 1931 when they brought in, the Securities Act of 1932 or whatever it was, where they said that they gave credibility to the fundamental analyst community, and they never mentioned technicians. So in that particular act that they wrote up, they gave specific credibility to the fundamental community and not market technicians, so people that study companies, not that study the market. That's one theory. Ralph knows more about this that world than I do, so I trust what he's saying. Why don't they admit they read charts? I have no idea. I don't know. I'm a technician. You know, people ask me about earnings per share or, you know, statement of cash flows. You know, I'll recommend somebody else to them. But if you want to look at a chart, you know, I'd be more than happy to do that. I'm a technician, so I would never have a problem admitting that I'm reading a chart. You'll never see me on TV talking about how great their CEO is of a stock or how great their balance sheet is. I really could care less. You know, you'll hear me talking about price or other intermarket work that I'm doing, or, you know, you guys know what I look at. What's the difference between RSI period and the average period? Because it seems the higher the average period I enter, the smoother and harder to read the RSI gets. And what average period to use? So I use a 14-period RSI, which is what Wilder used. If you want to get creative, Connie Brown, her book, off the top of my head, I forget the name of her book. I have it here on my shelf. It's called Technical Analysis for the Trading Professional by Connie Brown, and she does awesome work with RSI where she kind of changes the periods around, adds moving averages. She does excellent work. It's not something that I do. I'm very simple. My 14 periods. Obviously, the more periods, the smoother it gets. The less periods, the more volatile. You know, for sure. But if you're interested in, you know, fooling around with that, I highly recommend her book. She does brilliant work, for sure. Are you long Apple today? Are there any bullish divergences you have seen similar to the bearish ones you picked up in September that would indicate the stock has bottomed? No, we're not. We don't have an Apple position at all right now. There were some slight divergences in Apple, not enough to get me super excited. I was looking at 440. We bought it after 440. You know, we took some profits. We don't have any now. I think we got out of the last amount that we had yesterday, if I'm not mistaken. Yep, yesterday. I wrote a blog post on Apple 2 weeks ago, kind of just following up on that really bearish one from last year. It was written on March 15th. So you can go back on the blog and you can see everything that I'm looking at. I looked at the relative charts. I looked at momentum. I looked at a lot of things. So you get a pretty good idea of what I think about Apple. Again, it was March 15th on allstarcharts.com. Do you make use of reverse divergences? No, I do not. I don't. I look at bullish and bearish divergences. I know Connie Brown talks a lot about the reverse divergences, so I would look at that. How do you manage the amount of information coming in on any given day? I've noticed you have 500 people you are following on Twitter. Right. So I'm not on Twitter. I'm on StockTwits. You know, I'm on Twitter, you know, on the weekends or, you know, just for social reasons, I suppose. During the day, I'm only on StockTwits. So if you ever have any questions on anything that you're seeing, tweet at me at StockTwits, not on Twitter, because I don't have time for that. You know, I can't be worried about what Charlie Sheen had for lunch. You know, when the euro is crashing. So that's actually a great question. So I'm only it's All Star Charts. It's the same handle on StockTwits and Twitter. And if I'm tweeting from StockTwits, it goes on Twitter also. So you can follow me on Twitter. But from me, what I digest is only the StockTwits stream that I personally created with some of the guys I mentioned before, Brian Shannon and Greg Harmon and, you know, Ari Wald and all those guys. And you can see who I'm following on StockTwits, by the way, if you're looking for some good follows. All right, so what indicators are best to use for Forex? I use the exact same thing for foreign exchange that I do for bonds and commodities and stocks. Nothing's different. I use a 14-period RSI. I use multiple time frames, the same time frames I use in the other asset classes. To me, it's no different. I love your blog. I just wanted to say thank you. You're welcome. Do you make use of cycles at all in your work? You know, I don't. And, you know, we all have to admit, you know, where our strong points are and where our weaknesses are. We all have strong points. We all have weaknesses. As much as I could tell you that I follow RSI every single day, you know, at night, in the morning, every day of my career, you know, when it comes to cycle work, I'm just not there. I know some guys that do some brilliant work with cycles. It's not my thing. I use, seasonal stuff. So I use the presidential cycle. I will look at the seasonal trends in different asset classes and in stocks and things like that. So I use those cycles. I don't really do anything with astrology. I know guys that do, and, are looking, when the time changes and where the moon is and all this stuff, and that's great. And if it works for them, terrific. I don't use any of that. I don't use Fibonacci cycles at all. It's just not my thing. So I guess we're going to wrap up. Closing thoughts and plugs. Not really much. I mean, I think I pretty much, told you guys who I am, what I do, what I try to do, and I hope I did a good job. But yeah, that's what I look at. I look at, momentum divergences. I do my intermarket work, but I really wanted to get specific with RSI because I can't think off the top of my head anybody who really focused on this one indicator. And it's one that I follow very closely. So this is me. So I hope you guys enjoyed it.
And on behalf of the Market Technicians Association, I'd like to send our sincerest gratitude to JC, for spending some time with us today and delivering, again, an excellent presentation. JC, if it wasn't for technicians like yourself giving back to the MTA, we definitely wouldn't have the success stories like the one you shared with us earlier. So thank you. If you haven't had the chance, check out JC's blog. You can definitely do so at www.allstarcharts.com. JC is also very active on Stoxx, which, as he said, so there's certainly a number of ways to keep up with him and the great material he's always putting out. Also, I encourage you to check out his hedge fund website at gldcapital.com. As he mentioned earlier, he's put a tremendous amount of work into launching his new venture and has certainly done an excellent job thus far. I know there are quite a few questions that are still piling in, so if we could not get to your question today, please feel free to email any member of the MTA staff, and we will gladly pass those questions along. Alternatively, you can email JC directly at the address that was listed on your screen. I'll pull it right back up. There you go. You can email him directly at that email address right there, or find him on Stoxx at All Star Charts. One last thing before I let you guys go. Just want to send out one final reminder that the registration for the 2013 Annual Symposium is officially coming to an end. If you have not already registered, you have until Monday, April 1st to do so. Join us next week on April 4th through 5th and hear from a wealth of fantastic speakers such as Marianne Bartels, John and Pete Najarian, Ralph Acampora, Larry Williams, Martin Pring, Tom DeMark, Dr. Andy Lowe, Robert Prechter, Dave Lundgren, Maria Bartiromo, and many, many more. Give us a call at the office at 646-652-3300 or hop on to symposium.mta.org and get yourself signed up. For the MTA, I'm Shane Squark. I thank you for joining us today, and I look forward to seeing each of you next week at the 2013 Annual Symposium.